My name is Frank Caliendo. I'm the Academic Director of the Center for Growth and Opportunity, and I'm also the Department Head of Economics and Finance at the Huntsman School of Business. I'm joined today by Professor John Taylor from Stanford University, who is one of the leading economists of our day, and it's an absolute honor to have Professor Taylor with us today. Thank you, John, for being here.
It's good to be here. Thank you.
I'd like to start by talking a little bit about the U.S. debt. And this is a topic that you've commented on recently, the possibility that we have a debt crisis on the horizon. Government debt is at an all-time high, and that's pretty much always a true statement, but it has grown particularly rapidly in the last decade, and as a share of GDP, it's not been higher in the last 30 or 40 years, as far as I know. Of course, some countries have higher debt to GDP ratios. Japan, Greece did, but they got into a lot of trouble. So the question is, how much is too much, and when will the U.S. run out of credit, and what will be the consequences?
Well, it's a good question. We never know how much is too much. You can look at Greece and say, my gosh, let's not do that. You know, Japan has a very different circumstance. The economy is not that great, and different people hold the debt. I think there's lots you can learn from looking at history, though. It's a good way to think about it. And the problem is, at some point, it gets out of hand. Right now, the U.S. is fortunate. People around the world buy our debt. Interest rates are low. That's another sense in which the debt is less of a problem than otherwise would be. But neither of those like to last forever, especially if the debt gets very big. And so there's a danger of a spiral where the debt goes up, interest rates go up, debt goes up, and it creates a real problem for us. So I don't think there's any fixed level, but when it gets too high, other things don't work too well. Interest rates tend to crowd other kinds of investment. There tends to be more international pressure. So it's not a magic number, but it's a number to be aware of.
Mm-hmm. Mm-hmm. Thank you. A related question is why financial market participants don't seem to be more worried about the national debt. Yields on government bonds are quite low, and yields on long-term bonds are not much higher than short-term bonds, and have even dipped below a little bit in recent days. So the question is, why aren't financial markets more worried about the level of government debt that we have?
Well, first of all, they are worried about debt in certain countries, and even though those countries are part of the world, and so there's always that danger. The U.S. is integrated with other countries who also have large debts. You mentioned Japan. What's happening now is there's a tendency for interest rates to be lower than they otherwise would be. That's not related to the debt. Some people argue it's related to monetary policy. It's a very unusual monetary policy when you have negative interest rates or near zero interest rates. So that has an effect on interest rates more broadly. Some people think and argue that the economy is just growing more slowly, and so that's going to make the way you calculate the interest rates lower. And so all those things come into play. I don't think any of them are a reason why we shouldn't worry about the debt. There's other things. Some people think it's a reason not to worry about the debt. Some would tell to me, don't worry about the debt. The interest rates will just be set to zero or even negative by the Fed, or foreigners will buy our debt. So some of those things may be partially true in the short run, but eventually the end will be not so pleasant.
Let's turn to the related question of entitlement programs, such as Social Security. Typical government debt estimates do not include the unfunded liabilities in our entitlement programs like Social Security, but of course these programs are now out of whack as well. Tax revenues that we collect to fund Social Security are not sufficient to pay Social Security benefits. We've known this has been coming for decades now,
right.
The Social Security crisis. It's not a surprise. Can we kick the can down the road a little further, or is this something that we should really deal with right now?
I think it's better if we deal with it now. We can kick it down a little further, but not forever. We're on a trajectory now in the U.S. where the growth of spending is like an upward spiral, and the growth of tax revenue is sort of flat, or increasing just with the economy, was the way I should say it. So something has to give. In fact, that growth of spending is really the reason, I think, why you have the deficits and the debt growing. So to fix the debt and the deficit, you have to control the growth of spending. And it's not something that is, inherently a negative. I think some of the programs, most of the programs, will work better if they're not growing so rapidly or if they're brought into more manageable levels. And part of it is because you give some incentives for people, skin in the game sometimes it's called, with respect to the choices they're making. And those make the programs work better. So a lot of the reforms, and they, as you say, been around for a long time, are still there and they're on the shelf ready to pull down. But there doesn't seem to be the will right now. And it may be because there's other things on people's minds. It may be because the interest rates are low for other reasons. We don't know for sure.
Now, there's lots of different ways that we could reform Social Security. We could increase taxes, we could reduce benefits, we could do some combination of the two, we could delay the retirement age. Do you see any particular type of reform as making more economic sense than other types of reforms? Do you prefer one over another?
I think the main thing is to bring the program in line with what people are earning. It has to do with how it's indexed, whether it's to prices or wages. But right now, younger people are actually promised more as a fraction of their income than older people. So it's actually out of line that way. If we just brought it back into line so that current 45-year-olds can expect to get the same of their income as current 65-year-olds, it basically does away with the problem. So it's pretty simple to fix from an arithmetic point of view, but all those things I just said become politically very difficult, and it's complicated. So we haven't been able to do it yet.
Now, there's many things to celebrate in the economy right now. We've been recession-free for a decade. Unemployment rates are very, very low. Inflation's low. The stock market is strong. What types of indicators do you recommend that we look at and that policymakers look at when they score the economy, when they want to assess whether an economy is healthy?
I think one is to have a higher growth rate. You're right, we've had a growth rate since this recovery began, but it's a low growth rate. It's lower than most other recoveries. So while it's been long, and that's great, it has been very slow. So I think the highest priority would be to pick up the growth rate, and that would benefit all sorts of people, poor people, middle-income people, more jobs, more to go around. So that's what I would focus on, and I think indicators of what's causing low growth are low productivity, low investment, and we know the policies that will improve that, and so we should undertake that. It's not the only problem in the economy. There's income distribution, there's issues related to education, so there's more things to do, that's for sure, but I think in terms of an improving economy, some faster growth would be much better.
Yeah. As you look back over that slow recovery, what are the lessons that we as macroeconomists should learn from that slow recovery? Do you think certain policies made the recovery worse?
I do.
You've done more as policymakers?
I do, but I think the most important lesson is that Great Recession was terrible, and we do not want to have that again. And I think you can show certain policies that brought that on. One had to do with monetary policy, one had to do with housing policy. And it was terrible for people. Unemployment skyrocketed, it went around the world. And in many respects, we're still hurting because of that terrible event. The slow recovery, I think, is unrelated to the deepness of the recession. We've had much faster recoveries from equally deep recessions in American history. It was a much faster recovery in the 1980s, for example. And I think the policy is an issue. We really haven't had the tax reform until recently. We haven't had the regulatory reform until recently. And to some extent, that's because of the other policies that have been put in place. But I think as you look at why we had not as good an economy as we could have had in the last, during this recovery, you see these kinds of policies, and hopefully they will change.
Thank you. When you think about monetary policy and sound monetary policy, financial stability, what do those terms mean to you? And as you look to the future, what sorts of recommendations do you have for central bankers?
Well, sound policy to me is a predictable, rule-based policy where people understand what the policy is. The Federal Reserve or other central banks take steps and decisions which are predictable and understandable. And when we've had policies like that, it's worked very well. Much of the 80s and 90s were like that. And recently, I think we're getting back to that. So that's good monetary policy. And when you look at other countries, you see some good and some bad. And so you see a good monetary policy in Chile. You see not such a good monetary policy in Argentina, countries right next to each other. So that's what it is. It's rule-based, focusing on price stability, and very much being transparent about what you're doing. And I think that we get back to that, we won't have the same kind of problems which led to the great financial crisis. The problems like in 2003, 4, and 5, where policy seemed to get off what was working so well into 20 years before that.
My final question, Dr. Taylor, I know that you love economics and economic policy. If
Yes,
you
I
had
do.
it all over to do again, would you become an economist again?
Yes, it's a good question, though. I think I just love the subject, and I love the applications. I kind of get a rush thinking about the applications that economists, economic thinking can benefit from. So I'm always looking for those. I think the subject is beautiful itself. It's theoretically beautiful. The construct is beautiful. But if it wasn't for the policy side, I would be less interested. It's a very powerful way to think about the world. We've learned so much about which policies work and which don't, and we can apply those and communicate about those. So to me, it's a fascinating subject.
Wonderful. Thank you, Dr. Taylor.
Thank you.
Thank you so much.
Okay, great. Thank you.